This set of slides looks at strategic asset allocation for individual investors. So we discussed in this course that individual investors are taxable and must focus on after-tax returns. Asset allocation for individual investors must also account for the part of the wealth flowing from current and future labour income and the changing mix of financial and labour income related wealth as the person ages and eventually retires. Any correlation of current and future labour income with financial asset returns, and the possibility of outliving one's resources. We have also learnt in this course that psychological factors play a role, and behavioural finance points to a variety of issues that individual investors and their advisors face when determining the asset allocation. So risk, as we already know, is a really important part of portfolio allocation. An individual's investors' ability and willingness to bear risk depends on their personality makeup, their current and future needs, and the current and anticipated future financial situation, considering all sources of income. So the risks you can afford to take depend on your total financial situation, including the types and sources of your income, exclusive of investment income. Earning ability is an important determining capacity for risk. People with high earning ability can take more risk because they can more readily recoup financial losses than lower earning individuals. A person's earning ability is captured by the concept of human capital. So as we said, a person's earning ability is captured by the concept of human capital. Human capital is the present value of expected future labour income and is not readily tradable. In addition to human capital, an individual has financial capital, which consists of more readily tradable assets such as stocks, bonds, and real estate. Human capital is often an investor's single largest asset. Young investors generally have far more human capital than financial capital. With little time to save and invest, their financial capital may be very small. But young investors have a long work life ahead of them, and the present value of expected future earnings is often substantial. This is a formula for human capital, where T is your current age, small t, is your current age. I, capital I, is the expected earnings or income at age J. Capital T is your life expectancy. And R is the discount rate, the same as we use the discount rate in other formulas. So this is an example of a person that at age 25 has an income of $50,000. His income increases with inflation. The real discount rate for future income and mortality is 5%. The initial portfolio amount is $100,000, and the real investment return is 5% per year. And we've graphed this using the outcomes from the human capital formula. From the graph, you can see that when the investor is 25 years old, his human capital far outweighs his financial capital. There's the human capital and financial capital. Human capital is estimated to be approximately $900,000 and represents about 90% of total wealth, which is human wealth plus financial wealth, or human capital plus financial capital, while financial capital is only around $100,000, which is the initial portfolio starting amount. As the investor gets older, the investor will continue to make savings, contributions, and earn positive returns, so their financial capital will increase. At age 65, human capital has decreased to zero because they leave the workforce at age 65, and while the financial portfolio peaks above $1 million. That's a shaded graph of the financial capital. or the human capital to financial capital ratio. So human capital's importance is often underestimated. Ignoring human capital, individuals should optimally maintain constant portfolio weights throughout their life given certain assumptions, including assumptions about the investor's risk aversion. When we do take labour income into account, individuals appear to optimally change their asset allocation in ways related to their life cycle and characteristics of their labour income. In a book by Campbell and Becerra called Strategic Asset Allocation, the Portfolio Choice for Long-Term Investors, they reached several intuitive conclusions. Firstly is that investors with safe labour income and thus safe human capital will invest more of their financial portfolio into equities. The second, that is, investors with labour income that is highly positively correlated with stock markets should tend to choose an asset allocation with less exposure to stocks. And lastly, the ability to adjust labour supply, i.e. high labour flexibility, tends to increase an investor's optimal allocation to equities.